Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Irene Tunkel, Chief Strategist of U.S. Equity Strategy at BCA Research. We're here to discuss why the surge of consumer spend could fade into year-end, as well as corporate pricing power. Irene, it is great to have you with us. Welcome to TradeTalks.
Hi, Jill. Good to see you again.
You got it. And you're talking about the vicious troika here, right? Higher interest rates, the dollar, and energy prices. What does this all mean when we put it together, and how do you think that could impact the consumer?
Well, I think that this is almost like a lethal cocktail for equities. Hard to think of anything worse because it really affects every aspect of equities and actually consumer as well. Let's start with high energy prices. They hit consumers because now they have to spend more to fill up their car. It takes away from spending elsewhere. Considering that consumer is already under pressure, this is pretty bad. What is the pressure on consumers? Well, excess savings are running out, student loans are to be repaid, plus we know that many people who had to repay student loans took on other debt. So they're already under pressure. Job market is slowing. Now let's switch to US dollar. US dollar is bad for corporates because especially if we talk about the S&P 500, many of the companies in the index are multinational. So they derive a large share of profits and sales from abroad. Higher dollar makes US products more expensive. And also there is this tricky issue of accounting translation effect. So it's going to hit profits. And the last one is treasuries. Well, first of all, treasury yields underpin pretty much every interest rate in the economy. That's why mortgage rates are surging. Higher interest rates affect everyone. They affect companies, and we have quite a few zombie companies because for a large percentage of smaller cap companies, interest expense is larger than the operating cash flow. So they already have a hard time covering interest expense. So interest rates affect consumers because if they want to take new loans, it's very expensive. They affect corporates because it's much harder to refinance, and also the probability of defaults and bankruptcies increases. And also it makes the value of equities lower. It affects valuations. Why it affects valuations? Because now you can invest your money into treasuries. Right?
Well, let's talk about the consumer for a moment here because I feel like everyone's been betting against the consumer for the past 18 months, but then you saw the consumer spend data that came out last week, earlier in the week. I feel like every time someone bets against the consumer, they just come out and they continue to spend. Although I wonder at some point they're just not going to be able to keep up with the interest rates itself.
Yeah, I agree with you. And to be honest, I'm among those who bet against consumer, and consumer kept surprising. But we do know that default rates are picking up, albeit from low levels. And we also know that delinquencies are picking up. Plus, credit card balances are growing, and they're very, very high right now. And when we heard from the banks, like from Bank of America, we know that people are not able to pay off their balances. So balances keep on growing. So I think that maybe there are some pockets of consumer market that are able to spend, but it doesn't apply to the entire sort of American public, like Americans, because it's a very heterogeneous group. And also, if you have to spend more on gasoline and on some necessities, it will look like you're spending much more. When things cost more, retail sales, they are not adjusted for inflation, and they are not adjusted for volume. So if you have to spend more on fewer things, retail sales can look inflated.
I wonder if the strength of the consumer was really derived from what they spent on services, right? And experiences. Okay, you know, if you go on vacation and you have all the pent-up demand from COVID, that's one big expense, but it's not something you're going to spend on, well, not the average person, I'm certainly not going to spend on that vacation every single month. So it's not like it's a recurring piece of revenue to the economy.
I know, it's what is this meme? You only live once, revenge travel, that people felt that, well, you know, we see how things can turn out with COVID, we are not going to live forever, let's experience.
Right.
But I think at some point, when people run out of money on all these European vacations and vacations to Mexico are taken, people will come back to reality. And what do they face? They face higher credit card balances, and the interest rate on credit cards is very high. Plus, many of them will have to actually repay student loans, and they have car loans. Cars cost much more cars are much more expensive. So at some point, reality is going to hit. So you can avoid the reality for a little while, but at some point, people will become grown-ups.
Let's talk about the impact of geopolitics to the market. I mean, you know, we have Russia and Ukraine, we have tensions with China, you know, clearly what's happening with Israel and you know, the situation in the Middle East. It seems as if the market has somewhat taken it in stride. It hasn't, there wasn't a massive sell-off. There wasn't a massive move either way. But I feel like it's still very early days to some extent.
I think it is. First of all, it comes across that the world is a very dangerous place. At least I feel this way.
Yeah.
But I also think that investors are still sort of a little bit underestimating the importance of the conflict in Israel. And I worry that the conflict will spill out of Gaza. And I think it's a sort of well-known fact or well-accepted fact that Iran is behind Hamas. Mm-hmm. So the question is at which point Iran will come to the fore, whether Israel will really get attacked by Hezbollah from the north. And I think that it all comes down to what degree, US and Israel start to point fingers to Iran, and Iran has no choice but to kind of intervene, and there is a conflict with Iran. And this has tremendous implications for the price of oil. Mm-hmm. Saudi Arabia certainly can step in and pick up some of the slack, but all the oil tankers are actually going through the Strait of Hormuz.
Right.
So that already creates a bottleneck. And if we talk about the US, and US is energy independent, yes and no at the same time, because it's not clear whether US energy producers will be willing to increase their production, because so far they have been so focused on returning cash to shareholders and on capital discipline. And in terms of the strategic petroleum reserves, we're kind of running out of them. So it seems that if this conflict actually comes out of Gaza, what happens in Gaza doesn't stay in Gaza. Right. I think we're in for a very nasty oil shock.
Yeah, it almost feels like there is a regime or power shift, because it's on multiple fronts, right? So we have it in Eastern Europe, we have it in the Middle East, of course we have Asia that we're concerned with, and I feel, I'm just not sure if the market is so used to digesting news, because the news cycle moves so fast, that we're on another topic, or it just seems to be the market isn't digesting this in the way I had expected anyway.
I think I feel the same way, and in a way you can tie everything together, because China is talking to Russia, to Iran, and so we have these three very powerful countries that are trying to unite, and I think at the core of this is that Iran really wants to deter the alliance between Saudi Arabia, Israel, and America, because in that case, Iran will become isolated in the Middle East. Mm-hmm. So to a degree, perhaps this war in Gaza is to distract or kind of be in the way of this Abraham alliance, what they call it, between Israel, United States, and Saudi Arabia. They really don't want that. So I think that's what's probably at the core, like in terms of geopolitics.
So when you think about longer-term positioning right now, are you taking a more defensive posture, or is it business as usual with allocation?
Well, I think first of all, I would name three things that I would be overweight just on the back of recent events. I would be overweight aerospace and defense, because indeed it is a very dangerous world, and all of the defense contractors have tremendous backlogs of orders. And if anything, they will have even more orders going forward, because this ammunition is becoming depleted. My second overweight would be to energy. Our energy strategist, Bob Ryan, expects oil to hit 100, and then even probably above, like something like 118 next year. So I think that oil shock is still a probability that I would be prepared for. So overweight energy. And the last one is cybersecurity, because it becomes a warfare. Otherwise, I would be defensively positioned. Just back to the conversation we had about the consumer, I do think that the party is going to come to an end soon. Maybe I will be surprised again, and you cannot bet against the American consumer, but when I look at the data, this is just the logical conclusion I arrived to.
All right, Irene, appreciate the insight. Thanks for joining us.
Thank you very much.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.